Think of an investment that you can buy and get exposure to thousands of companies or bonds all within one purchase. That right there is an ETF, and although there are actively managed ones, this video is going to cover only index-based ETFs. This means that each of the funds discussed in this video track particular markets, and by combining all of them together, you're going to be getting substantial exposure to many different markets across the entire world. Although this may seem boring, it's extremely easy, requires little financial knowledge, saves you time, and crazy enough, stock picking has a terrible track record. And even in 2022, with the odds on the investor side, most still trailed the market. So in search of some wisdom, I came across a famous quote by the legendary investor Warren Buffett, who states, "A low-cost index fund is the most sensible equity investment for the great majority of investors." And with that being said, the 3 ETFs that you are going to learn about in this video will allow you to create an easy 3-fund portfolio, which I'll explain throughout this video. All right, so let's get started with the first one being the Vanguard Total Stock Market ETF, ticker symbol VTI. VTI is an ETF that seeks to track the performance of the CRSP US Total Market Index that consists of small, mid, and large cap stocks. This fund is known to be a domestic fund because its holdings are only in the US, and because of that, you are pretty much getting exposed to the total US stock market. Currently, VTI has 3,883 holdings in the fund, with some of its top holdings being Apple, Microsoft, and so on. This index is also market cap weighted, which means the company's weight in the index is based on their size. As you can see, Apple is the biggest company in the index and contains the most weight at 6.22%. So the larger the company, the more weight it's going to carry toward the performance of the fund. For example, if Apple were to go bankrupt, you would see a significant impact on your portfolio rather than if a small cap stock like Robbie's Pizza Deluxe went bankrupt. But from there, summing up the top 10 holdings, it comes out to be roughly 25.9% of the entire portfolio, and the top sectors in this fund include 30.1% technology, 14% consumer discretionary, and many others you can see if you pause the video. This means that the largest sector being technology at 30% of the entire market is primarily due to demand toward that sector. Think about Apple being the largest stock. It would blow my mind if one of you watching this has never heard of the company Apple. Moving on from there, the Vanguard Total Stock Market ETF has in the past 10 years averaged 12.29% of an annual return. In addition to that, since 2001, which includes most of the lost decade, the returns came out to be roughly 8.07%. I'm going to show you exact results from a 3-fund portfolio approach at the end of this video, but if you were to invest $10,000 into VTI, for example, let's say at an average 9% rate, after 10 years, you would have nearly $24,000. The most important part about index fund investing is that the returns are seen from holding the fund for a long period. There have been several years with major downturns, and if you were to sell during those times, your portfolio would be impacted significantly. I mention this because in 2008 alone, VTI dropped roughly 38%. This means if you had $1 million invested, that would have dropped to $620,000. If you were to have held onto that $620,000 in 2008 without even adding any more contributions, by today, your balance would have grown nearly 5 times its value, and that would be over $3 million. This proves the importance of staying disciplined to the plan, never selling your positions early, especially in poor economic times. Now, another benefit to VTI is that it is extremely cheap. Its expense ratio, which is the total cost per year it takes to own the fund, is 3 basis points. That means for every $10,000 invested, you are only paying the price of a hamburger, which is $3 every year in fees. And if you didn't know, these expenses come directly from your investments, so you don't manually have to do anything. By keeping the fees low like this one, which all the funds discussed in this video are, it is extremely important toward building a strong portfolio to build wealth over time. If you were to own actively managed funds your entire career, you would be missing out on potentially hundreds of thousands of dollars, and that's for the majority of people, not just the wealthiest ones. Although owning an entire US stock market ETF is great for exposure, economic development and political issues could still hurt an economy at any instant, which is why it's great to diversify with bonds and international funds. That said, let's move on to discussing the second ETF, that is the Vanguard Total International Stock ETF, ticker symbol VXUS. This fund seeks to track the performance of the FTSE Global All Cap excluding US Index, which measures the performance of stocks issued by companies located outside outside the United States. By doing this, your portfolio becomes much more diversified, and say that the US stock market was to go down 40 to 50% in a year, an international fund may even be up in value during that same period, which that would help out your portfolio from a significant drawdown. This is why the wealthiest people spread their investments around many different markets to hedge against risk. Something I learned and found extremely valuable is that when you're investing in the markets, the goal is to not lose money rather than what most people think of it as to make the most amount of money. I say this because when you lose in the markets, you have to gain a much higher percentage back just to get to where you started. For example, if you lose 50% in the market, you would need to gain 100% back just to break even. And if you had a terrible stock that went down 90%, let's say, it would need to go up 900% just to break even for you. To sum it up for you, don't put all of your eggs in one basket. Now, this fund is also market cap weighted and includes 7,964 holdings, with some of the top holdings being Taiwan Semiconductor at 1.52% and Nestle at 1.1%. And then you can also see the exposure by region, where Europe contains 40.9%, then emerging markets, and then Pacific as the dominant leaders. Fun extra fact for you, Japan and the UK are the top countries with companies in this fund. And this fund over the past 10 years has averaged 5.09% per year. With that being said, let's now move on to the last ETF, that is the Vanguard Total Market Bond ETF, ticker symbol BND. Now, this fund seeks to track the performance of a broad market-weighted bond index that will generally include treasuries and mortgage-backed securities, to name a few. The pros to buying a bond index fund is that it can be much easier for you to buy and sell than individual bonds. They also allow you to invest any amount of money, and most bond funds typically pay out interest on a monthly basis, where individual bonds are typically semi-annually. Which right now they currently have a 30-day yield of 4.43% due to the Fed raising interest rates. Now, because bond funds are much safer investments, the returns you're more than likely going to see are going to be much smaller. As discussed earlier, diversification is extremely important toward building a strong portfolio, and by getting involved with bonds, the exposure will allow you to get a source of reliable, low-risk income. This bond fund currently has 10,476 holdings, where the biggest portion comes from US government securities. You can also see that the largest holdings in the fund only cover 0.03% of the entire portfolio. And you can also see right here what the typical maturities are and how much of each are held inside of the fund. Now, this fund over the past 10 years has averaged 1.5% per year. Now that you have a good understanding of what these three ETFs are, I'm now going to explain how you can create an extremely easy three-fund portfolio for yourself. This portfolio is also known as the lazy portfolio because it's so easy. I already know that for the majority of you, if you take this approach, when you finish, you're going to want to do this.
That was easy.
Before we dive into this, I want to show you the overall benefits on why you should consider taking this approach. First, it is simple and easy. Second, it has solid diversification. Third, it outbeats professionals. Fourth, no financial advisor fees. Fifth, there's no actively managed fund fees. And sixth, it requires little time. So with that said, a three-fund portfolio consists of three different asset classes: domestic stocks, which is VTI, international stocks, which is VXUS, and domestic bonds, BND. Although you could add more investments that you like and still have these three asset types, the simplest and easiest way to do this is by benefiting from the three funds I've just discussed that still give you full exposure to the markets. And because everyone has different positions, I'm going to briefly go over three different approaches that you could take and how they've historically performed since 2012. The first one being an aggressive approach. This means that you would have 65% domestic stocks, for this case VTI, 15% international stocks, VXUS, and then 20% domestic bonds, which is BND. By using these exact investments from 2012 to 2023, you would have grown $10,000 into roughly $28,000. Based off of this data, you would have achieved a compound annual growth rate of 9.5%. This was a major factor into the creation of this video and why I decided to create my own portfolio using M1 Finance, because it's extremely easy and anybody can do this while still reaping tremendous returns over time, although past performance does not guarantee future results. Now, if your position right now isn't aggressive, you could then take a moderate approach. That means you would split 1/3 for each investment type. This means that you would take, for this example with the software, it has to be 34% because it can't do 33.3, but that would be 34% domestic funds in VTI, 33% VXUS, and then 33% in the bond fund. By taking this approach based off history from 2012, you would have grown $10,000 into roughly $21,000, which means you would have achieved a compound annual growth rate of 6.78%. If neither of those interest you and you need to be even more conservative, well, you could take the conservative approach, which is 80% bonds, 15% domestic stock, and 5% international. By taking this approach based off history since 2012, you would have grown $10,000 into nearly $15,000. That would mean you would have achieved a compound annual growth rate of 3.39%. You can see that by taking this approach, because majority of the portfolio is in bonds, you're less likely to see your money grow significantly, but you're not as likely to have a major drawdown. But if you are interested to learn more about this 3-fund portfolio approach, I made an entire video covering every detail you need to know about. I'll leave a link in the description below and a pop-up right here, and in that video includes a free template to help you get started. So if you are interested, it literally takes less than 5 minutes to start, and with M1 Finance, it's extremely easy. They automatically help you with allocating and rebalancing your portfolio. It just takes a couple buttons. So if you want to do that and get a $100 bonus, use the link in the description below and deposit $5,000 within 30 days of opening the account, and you will get that $100 bonus. And while you're at it, if you want to see my entire portfolio and how I allocate my investments, consider joining the Patreon community. With that being said, don't forget to hit the like, subscribe, and notifications button to be alert for future Money Talk content like this. Thank you.